They are falling behind the United States and China as far as technology goes, as far as innovation goes. They need to invest about 750 to 800 billion euros every single year into Europe in order to get things going. Europe, which is already growing at a painfully slow pace, is telling us that they expect to grow even slower, and these rate cuts are an effort to try to get things going. The European Central Bank just cut interest rates by 0.25% on Thursday. This is the central bank's second rate cut in 3 months, and it takes their benchmark rate to 3.5%, down from 3.75. Now, the central bank did also issue lower growth forecasts. So in this video, we're going to discuss this rate cut by the European Central Bank. We're going to talk about what it means for markets, what it means for the economy. And before we get started, let me just say that if you like content like this, leave a comment down below letting me know what you think. Make sure you subscribe for more content like this and hit that thumbs up button for me. Europe is in a period of snail pace economic growth. The European Central Bank is actively in a rate cutting cycle in an effort to achieve a more robust economy. Financial conditions are restrictive there, economic activity is slow, and there is weak consumption and investment in the moment. Now, the central bank just issued their second rate cut in 3 months, so the benchmark rate is now sitting at 3.5%. That is down from 3.75%, and they did cut in June. They did not cut in July, but Europe, knowing the situation that they are currently in, they are trying as much as they can to try to, ease things for consumers, ease things for businesses, but they did also issue out lower growth forecasts. So the central bank issued a 0.8% GDP growth forecast for this year. That is down from 0.9%, and they also lowered the 2025 and the 2026 forecast as well. Basically, Europe, which is already growing at a painfully slow pace, is telling us that they expect to grow even slower, and these rate cuts are an effort to try to get things going. Now, it's important to note that Germany, which is Europe's biggest economy, probably the most important country there, that they are starting to grow at a very slow pace. Their growth has kind of hit a halt, if you will, and they're kind of getting close to recession levels. And the central bank, they obviously know everything that's going on in every country, but to see Germany, which does do a lot of output, they're pretty innovative compared to some of the other places there, they are having a hard time as well. So it's really hitting the whole block. Nobody's really doing good there at the moment. And Mario Draghi, which is a former central bank president, he's a former Italian prime minister. He's somebody that's very prominent, very well respected in Europe. He recently put out a report discussing, how Europe can kind of get things going. And some of the things that he said, now this was a very widely looked at report. It's been all in the news lately. He says that Europe is facing an existential, I knew I was going to mess up that word. I've been practicing it. Their existence is in jeopardy at this point, that they are falling behind the United States and China as far as technology goes, as far as innovation goes, and said that Europe as a whole, the European Union, they need to invest about 750 to 800 billion euros every single year into Europe in order to get things going, in order to get, Europe just out of the stagnation that they are in right now. And now this report, it was received, different ways from different people. I completely agree with a lot of what the report says, because right now, Europe as a whole, they are very stagnant. The growth that we are seeing, again, snail pace, it's barely there, and you're risking, and this has been going on in Europe for quite some time, and he is correct that, the United States has been innovating. While we do run really high debt levels here, it is in an effort to try to, keep our economy growing and You have big businesses here, it's open. China grows in different ways. Now, China has its own struggles, but they also invest very heavily in themselves. He is saying Europe needs to do the same thing if they are going to compete, if they are going to get out of this rut that they are currently in. Now, the current central bank president pretty much did agree with the things that he was saying. She said that the report it's pretty much spot on, but it is for those governments to decide how they are going to come up with the money. The idea of coming up with this 800 billion every single year, the governments have to figure that out. That is out of the central bank's hands. But she did agree that yes, the things that he is talking about in the report, investing in technology, just investing in Europe, spending the money that's necessary in order to achieve the growth that they want is, it's something that they should do. But again, a lot easier said than done how you're gonna do it. And I really do think that the European Central Bank, it's a little bit more difficult because you have 20 different countries in there, and these countries, they have different economies. Some are on the coast, some are more inland. What they produce and how they make their money, it's very vast, very diverse, and that presents some challenges when you are trying to do something like this, coming up with this money. But maybe they come up with a toned down version of it. Maybe it's not 800 billion a year, but some type of investment into Europe, into modern technologies, into the economies there to kind of get some growth going, because right now, and for a little while now, it has been very stagnant. And with the second rate cut in 3 months, traders are kind of split on when the next cut will come out of Europe. They have a meeting in October. Traders are some think that they might cut at that time, some think that they might not cut at that time, similar to how they did in June but then didn't in July. Now they did in September. A lot of people do think that they will cut again before the end of the year, but something that it might be in October, something it might be in December, while others think they might cut at both times. That's to be seen, but these rate cuts out of Europe, they are a welcoming sign. It is something that they do need to do in order to get out of this stage of stagnation that they are currently in. If you like content like this, leave a comment down below letting me know what you think. Make sure you subscribe for more content like this and hit that thumbs up button for me.